Good afternoon, everyone. I just want to thank you for joining us on today. I'm Jasmine Hillman, Outreach Manager for the DEC at Redbird, and I lead our community engagement efforts as well as manage our collegiate partnerships. Here at the DEC, we definitely value your voices, and we understand what an urgency it is to get as much information as possible around this subject matter. So we were able to bring together an amazing panel to just pretty much help you all navigate this PPP loan process. And definitely this is something that would typically take about probably 2 hours. So it's definitely a wealth of knowledge that we're trying to give you in just an hour. So definitely bear with us and understand that we are definitely going to send out a resource toolkit in the event that you don't get your questions answered during this time. We're going to try to cover as much as possible. There will be a high-level overview. So we will get some questions in, but definitely we'll do a follow-up, and we'll also send the video out if that helps as well. So looking forward to just, sharing this information with y'all. We hope it's beneficial. And I'm going to turn it over to our amazing panelists. They're going to introduce themselves, and then we're going to jump right in. Kelsey, you can take it away.
Okay, welcome everyone. Are you seeing the stage?
Yes, you're good to go.
Okay, great. I'm just getting the presentation pulled up. As Jasmine mentioned, we're here to talk about PPP today. I am here with my co-panelists, Keith Davidson and Chase Murphy. My name is Kelsey Shofner. I am the managing member of Shofner Consulting PLLC. I'm a business attorney focused on the legal needs of startup and growing businesses.
Hi, I'm Keith Davidson. I am a consulting CFO and principal at Clifton Larson Allen here in Dallas. I lead our outsourced CFO and accounting teams both in Dallas and Texas overall.
Hey there, everyone. Thanks for joining. It's Chase Murphy. I'm a tax partner at Baker Tilly. We're a national CPA firm. I help lead our entrepreneurial services tax practice for the Texas region, and look forward to hopefully making a connection with all of you guys. So thanks again for joining.
Okay, quick agenda. I'm going to go over just some of the major components of the Consolidated Appropriations Act, also known as the CAA, that refunded or started a second round of PPA funding just a few weeks ago. Chase is going to talk about the employee retention credit, and then Keith is going to go a little bit more in depth on PPP. And as Jasmine mentioned, we'll hold time at the end for questions, so feel free to put them in the chat. So the Consolidated Appropriations Act did a lot of things. It funded the government in general, not just PPP and COVID relief funding. But as far as COVID relief funding, as many people know, it released an additional round of stimulus for individuals and married couples up to a certain amount of income. It's my understanding that those payments have already started to come through from the IRS. It also extended the additional unemployment benefits that were set to expire at the end of the year. And it created some hiring incentives, gave relief to certain industries specifically, including shuttered venue grants, which if that applies to you, that's a good question to ask one of us offline about. Created disaster recovery areas for EIDL loans that are not coronavirus related. It also extended the paid leave act under the CARES Act from earlier in 2020. Extended some energy credits, some new opportunity zones, and it has given some debt relief for existing SBA loans. Then as far as PPP, so the first round of PPP, as probably most of us know, the initial funding amount went almost overnight. Very few very small businesses were able to get the money. And so Congress did refund the first round. So when we're talking about this PPP2, it's sort of the third time around that money's been released, but this time there's actually some new rules and guidance that have been issued for this particular round. So it has part of the CAA in relation to PPP created a simplified forgiveness process for loans that are less than $150,000. This would apply to both the initial round and this current round. It made some clarifications on what business expenses can be used and clarified that the business expenses used are still tax deductible. This is in addition to the fact that loan forgiveness under the PPP is not a taxable event, which most loan forgiveness programs are. So those apply to both rounds. But for this new round, we're looking at a maximum loan amount of $2 million, which is significantly less than the first round. But the point of the newest round is to hit some of the smallest businesses that really were left out the first time around. It has also allowed additional payroll and non-payroll expenses to be paid using PPP funds, including healthcare costs for employees. But there are some new requirements, some clarifications and some tightening of the requirements. The first time around, you basically had to have a tax return for 2019 and believe you had an economic hardship. For this second round of funding, it has been clarified that the business had to be in business as of February 15th, 2020. So new businesses that have opened since COVID arrived in the US and started impacting our economy are not eligible for PPP, but I would highly suggest that you stay on this presentation because Chase and Keith have some great information about some other opportunities that are available under the CAA. The number of employees, the max number of employees has been reduced from 500 to 300. And then they put out a very specific test for a reduction in gross receipts quarter over quarter. And Keith will talk more to this, but basically to be eligible for PPP, you've got to take one quarter in 2019 and compare it to the same quarter in 2020 and show a 25% reduction, plus have a continuing economic hardship. And again, we'll go over this a little bit more later, but we did want to clarify that if for some reason you're not going to qualify under the second round, but under the first round you would qualify, the first round is still open. And if you qualified under the first round, took money, it is possible to get additional funding under the second round if certain requirements are met. Maybe of interest for a handful of people on this call, but non-501c6 nonprofits are now eligible as well. So one thing that was a big change in this round of PPP is that rather than releasing it to all financial institutions who were interested in providing the funding, the initial money has only been not given to, but applications for this money have started with community financial institutions. These are smaller institutions that are more locally based. The point is to try to reach small businesses that really got left out that first time. If anyone on the call had a banking relationship at one of the big 5 banks and tried to get that money, it probably didn't happen. They were extremely overwhelmed. They were dealing with their large customers. So this time around, the government made a really conscious effort to make sure that access was available to small businesses. So right now, you can go to community banks, credit unions, community development financial institutions, and also alternative lenders like fintech. And just a quick note on this, for those that aren't familiar, community banks in Texas are a very specific type of bank. They are not credit unions. They are FDIC insured financial institutions, but they serve localized markets. You can Google Dallas community banks or Fort Worth community banks to find a list. There's quite a few of them. They are great resources, not only for PPP, but small business banking in general, as they provide a much more personal relationship, and the process can be a lot easier for PPP. Credit unions, of course, are a specific type of financial institution. Community development financial institutions are locally based groups that try to get money into the hands of traditionally underserved populations. Here in Dallas, we have People Fund. Actually, it's throughout Texas, but there's a local People Fund chapter here in Dallas. They're a great resource for PPP right now. Then you can also look into fintech solutions. I've put 2 links here. We will send out the slides after the presentation so you can access these links, but of what are known as fintech companies that are offering PPP applications. And that can be another good resource if you are banking with a larger, more traditional bank and are unable to get through the PPP process right now. So another large component, the CAA, was an extension and modification of the employee retention credit. And I'm going to actually hand this over to Chase to talk about. This is something that's been very underutilized because it's been very under advertised. And so we felt like it was important for small businesses to know about the ERC and how it's going to work with both first and second round of PPP.
Yeah, thanks a ton, Kelsey. I appreciate it. And thanks again for everyone joining this afternoon. As Jasmine had kind of mentioned initially, this will be kind of a high-level overview. The reality is I could probably spend the better part of an hour or 2 talking about just the employee retention credit as well. But I'm excited to bring a little bonus content to you guys today. I know the heading of the event and a lot of the expectations around PPP, and rightfully so. It's a great stimulus program for small business owners and otherwise. So excited to get to share some information with you on that front as well. But as Kelsey had mentioned, there's been major modifications to how the employee retention credit works. Most notably, it's now available to PPP recipients. So I'm sure many of you, like myself, were most focused on PPP opportunities on the initial round of stimulus when the CARES Act was initially released. And when we found out that employee retention credit wasn't eligible to those PPP recipients, I think we all just kind of wrote it off in the back of our mind. So today we'll talk about a couple key areas, a couple key changes. Kelsey, if you can go to the next slide here. Hold, please. Perfect. Yeah, so won't get too far down in the weeds, and we'll kind of glaze over a couple of these slides, but these are the 2 main changes that really wanted to highlight. So, one piece of the new legislation essentially makes the ERC available to PPP recipients. So perfect. That's setting the ground that, even though maybe I hadn't taken advantage in the past, I should go back and look and see whether there's some opportunities to go back and look at even 2020 payroll taxes and determine whether there's an opportunity to get a benefit of a credit in conjunction with my PPP loan. Second piece of it extends that payroll tax credit for the first 2 quarters of 2021. So previous legislation provided the opportunity for the employee retention credit through the end of 2020, through the 4th quarter. This guidance allows to extend that through July 1st, which is effectively Q1 and Q2 of 2021. So for those of you that are already familiar with the credit, maybe took it in 2020, this is just an opportunity to extend that under some new computational rules, but to continue to take advantage of that for the next 2 quarters. So carrying on to the next slide here. So just to quick lay the groundwork for everyone, I'm sure some of you are probably asking, what is an employee retention credit? That's great. I wrote it off, never really looked into it. So to quickly mention, I'd alluded that it's a payroll tax credit previously, but there's some different eligibility requirements than what would be relevant for a PPP borrower. So there's 2 primary criteria that you have to meet, one or the other, to be eligible for the credit. The first being that your business is fully or partially suspended due to government order, and the second would be a greater than 50% reduction in revenue for any quarter comparable to the same quarter in the prior year. So those are the 2 primary hurdles that you have to try to get across. The credit itself is 50% of qualified wages, up to $10,000 for a changing rule, but for 2020, it would have been for an annual basis. So it's a credit of up to $5,000 per employee to payroll tax credits. So it's potentially a great opportunity, especially for those that have a handful of employees, or certainly for those that have many employees. A couple main points I'll mention here is for any quarter where you meet the 50% reduction, the entire quarter would be eligible for consideration under the credit. Whereas for the suspension test, it's only during periods when you were suspended due to that government order. So for Texas, that you had the initial quarantine period and kind of the April timeframe. If your business was shut down either fully or partially during that period, it'd be an opportunity to go back and look at that time frame, and wages that were paid during that time frame may be eligible for credit. So touch a bit more on that here on the next slide or two. Okay, so quickly defined as suspended, I mentioned it previously. You've actually got to meet all three of these criteria. So if you chose voluntarily to slow operations or to shut down hours as an abundance of caution, that wouldn't be eligible. It has to truly be under a government authority. Those orders would have to limit some level of commerce, travel, group meetings, hours of operation, et cetera. And the orders would inflect your specific operations to be able to function in a typical manner. So those are the three categories that you'd have to meet to be suspended. Going on to the next page here, we'll define, I believe, what it means to be in business. So won't spend any time really here. Just basically defines what a trade or business would be. Specifies that a household employer wouldn't be in consideration for this, and self-employed individuals, the compensation you pay yourself wouldn't be eligible. It's truly for other employees that you may be still compensating. So carrying on. And again, some of this we'll try to make the content available for you all to reference. I know I'm going fairly quickly through a topic here, but want to make sure we leave a ton of time for PPP. So hitting kind of the high points. When we talk about, okay, a credit's a computation of qualified wages. So what are qualified wages? This is where a hurdle comes in terms of headcount. So for fewer than 100 employees, you're considered to be a small taxpayer, and the amounts paid to any employees during your eligible periods would be potentially eligible for the credit computation. For those large businesses, defined for this purpose as greater than 100 employees, only amounts paid to those not working would be eligible. So to the extent that you're a restaurant and you're closed entirely and your employees aren't able to work, but you continue to pay those folks, those would be the type that would be eligible in that example. Whereas fewer than 100, even employees continuing to perform services, all their compensation would still be eligible. So there's a little bit of an illustration on that here on the coming slides. I think that's good for this one, Kelsey. Oh, back one. So this slide basically talks about the key changes for 2021. So I mentioned it very quickly earlier, but there's kind of two different computation aspects when you look at previous quarters for 2020 and how those would be computed and what would deem you to be eligible. They've expanded that criteria for 2021. So said differently, the credit eligibility for Q1 and Q2 of 2021 is going to be available to more businesses due to some lax standards of what would make you eligible, and would be more meaningful in that the amount of the credits increased. And so again, there's an illustration on a future tab that will hopefully provide a little bit of added context, but the key changes would be that in 2020, it's a cap of $10,000 compensation to an employee for all quarters. So essentially for the entire year, if you're eligible in each quarter. The 2021 credit is a quarter by quarter analysis. And there, again, there's a good illustration of that here in just a second. The credits increased from 50 to 70%. So instead of it being a max of 5,000 per employee, it's a max of 7. So great windfall there. And instead of needing a 50% reduction in revenue, you'd be eligible with a 20% reduction. And that would be comparative to Q1 and Q2 of 2019, actually. So much more people and much more businesses will be potentially eligible to benefit just due to kind of the expanded parameters of qualification. And then the last piece would be it increases that 100 employee delineation for large employers to 500. So for employers with less than 500 employees, compensation paid to all employees, whether or not you're suspended, would be eligible, as opposed to in a large employer context, only those wages paid to employees not serving would be eligible for the credit. So going to the next one here. And I know I'm talking super fast, everybody bear with me, but again, hopefully you can at least provide back reference to some of these slides. And I think the biggest key here is just knowing if you're now potentially eligible. It's something worth digging into in conjunction with your PPP, which Keith will talk about in greater detail here in just a few, but certainly things that it's worth just highlighting at a high level, and then always happy to dig in a bit more. We can go on to the next slide. That chart's just a little illustration of the changes that I just mentioned. So these next two I'll kind of hit quickly, but I think these are paramount in providing a nice illustration here. So maybe stay on the first one for just a quick second. what this is basically illustrating is that in 2020, if we had 4 employees and we were eligible for the computation, Kelsey, I don't know if you can go back to the previous one for just one quick second. What it basically shows is that you cap out very quickly. And so that $10,000 on an annual basis, if you were eligible in all quarters, you get limited out very quickly. And that employee B, for instance, after Q2, no longer has any eligible wages for the credit because they're maxed out at their 10 for the year. And so if you were to walk it through each quarter, you basically come up with a potential credit of $18,000 over the course of all 3 quarters for the employee fact pattern that's laid out here. And so if we fast forward that to the next slide and look at it for 2021, what it effectively illustrates is that in just 2 quarters of 2021, I could potentially benefit from almost twice the available credit. So a potential credit of almost $33,000 for the same fact pattern, same 4 employees, compensated for the same amounts for Q1 and Q2 relative to the prior year. But because we can maximize that $10,000 per employee per quarter, we get the advantage of taking 2 different quarters of comp for B, for instance. And then that 70% credit's obviously much higher than the 50%. So with 1 less quarter, we're potentially benefiting from a significantly greater credit in 2021. So even if you elect not to go back to 2020, if you're eligible now, it's something worth considering for 2021 and could be hugely advantageous. So I'll try to wrap up here quickly and then turn it over to Keith. You want to leave plenty of time. I think there's maybe 1 or 2 other points here to touch on. We'll just mention this again as a payroll tax credit. It's reported on your Form 941. Would encourage you to coordinate and start talking to whoever handles your payroll tax reporting. It's basically a reduction of your withholding requirement that has to be paid in on a quarterly basis. This is different than PPP in that no deduction is allowed for wages equal to the amount of the credit. And so if you were thinking about, in the previous example, potentially a $33,000 credit, you would have to reduce your compensation amount by that for tax purposes. So effectively, your benefit is reduced by the marginal tax rate of the taxpayer. So just something to think about there. Just consult your local resources, or we're all certainly happy to answer some questions on this too. So I think maybe 1 or 2 quick other points, Kelsey, and then we'll turn it over. So the last 2 slides here are kind of high level coordination with PPP. Again, I won't get into great detail here, but there's kind of 2 different schools of thought. So first school of thought would be, if it sounds like you were eligible and that you had either 50% reduction in revenue or were fully or partially suspended during 2020, even if you took PPP, it's probably worth going back and doing a little modeling exercise to figure out, could I still take advantage of some employee retention credit as well? And that would be more of an arrears look. The main things to think about here, and outside the scope of this convo to get kind of down in the weeds there, but it is limited to wages not included in PPP forgiveness already. So basically no double dipping. So the idea would be that if you had compensation costs above and beyond what was already included in the PPP forgiveness, or the amount you needed to achieve forgiveness, it would be kind of that excess compensation that would be eligible potentially for this credit. So that's a little bit of a different way to think about it in terms of in arrears or back to 2020. Next slide will provide a couple of quick points on coordination on a go-forward basis. So if we've already had first round of PPP, we got it forgiven, and now we're looking at going potentially and applying for a second draw PPP loan, but that Q1 and Q2 potential employee retention credit looks appealing as well. It's a little bit of a different conversation going forward in that we now have the benefit of foresight, as opposed to maybe we would have potentially planned some things differently in the past. Now we can be pretty strategic about what wages do we really need to qualify to meet that 60% burden to achieve forgiveness, which is a very valuable benefit in this stimulus. But how can we make sure that we're being strategic about, maybe maximizing the 40% bucket of other costs that still allow you to achieve forgiveness, but free up some additional residual compensation that you can then get the benefit of the employee retention credit for there. So again, lots of guidance to digest in a quick 10-15 minute rundown. I actually did this similar presentation over the course of a little more than an hour a week ago. So it's very much condensed, but hopefully it was at least helpful initial context. Happy to answer any questions as we may. And then we'll turn it over here to Keith on the spirit of PPP to let you kind of run with the true star of the show today. So.
Hi, everyone. Keith again. Yes, let's talk about PPP. Chase, Kelsey, and I have become more intimate with PPP over the last year than we ever really thought we would ever be with any type of government. program. But if you're like my clients or any of the other panelists' clients, you need it. It's a big problem. I've seen a lot of questions come in through the chat. We're going to make sure we answer those throughout this, and if not through the presentation, we'll make sure there's time for questions at the end. So first of all, I want to clarify for PPP round 2, a lot of people have immediately thought of the second draw, but the round 2 headlines really was kind of multifaceted, not just for the second draw, but for the previous one as well, if you did that. So first, there is a second draw loan, which we're going to talk about that. The recent act for both the first and second loan did expand a little bit of the categories you can actually spend it on and be forgiven for, which is important. Borrowers for either loan can elect a longer forgiveness period. That is still in place, if you've been aware of that recently. And then one part that I know has been extremely helpful for some of my clients, it's greatly simplified the loan forgiveness for loans of $150,000 or less. So that's really important as well. And then finally, the business expenses or paper are tax deductible now. For a while, there was ambiguity on whether or not it would be deductible. So that was a big important part of this too. Kelsey, you can go to the next slide. So one of the first things I want to make clear, and I saw this in a question. So if you did not have any revenue in 2020, to be eligible, for the first draw, you need to have been in business in February 2020. So that's something that is really, it's really black and white. If you have to prove you were in business as of that point to participate. For the businesses with PPP loans, as Chase mentioned, can now take advantage of the employee retention tax credit, which is new as well. But the takeaway on the changes is the new borrowers can still participate for the first draw, but you had to have been in business since February or back in February 2020. You can go to the next one, Kelsey. So the changes to the cost, which I know is important. When this first came out, there was a lot of confusion on what's payroll cost. I never realized there'd be so many problems with defining payroll cost, but apparently there is. So now you can include group life, disability, vision, and dental insurance in that 60% bucket that the overall loan should be spent on regarding payroll. But one of the areas that's really interesting to me, it really helped a lot, is that there's new qualified cost that's in the 40% bucket of non-payroll costs. So now you can use it on some other operating expenditures, whether it's IT software or infrastructure, property damage not covered by insurance, any type of out-of-pocket cost like that, and even some supplier and cost, and then worker protection cost, which I know has been a really important factor as well. So that's good news to a lot of companies, because before, at least for some of my clients, I'm sure Chase and Kelsey as well, payroll is a huge part, but trying to have minimum staff or perhaps other costs that came up was really important. So those are now included as well. You can go to the next one, Kelsey. So the second draw term, so the round 2 max is $2 million, as Kelsey mentioned. The reason for that, a rationale for that, is they really wanted to focus much more on smaller companies. Now, when it comes to getting the second draw, if you did get the first draw, you need to show that you or illustrate that you will use the first draw proceeds in its entirety. Now, if you had more than $150,000 loan, you actually do, according to the last couple of days, you do actually have to have submit for forgiveness at the same time or before as you do for the second draw. That is different from if you don't need the second draw, when you need to file for forgiveness in general. I saw that question, and we'll address that in a minute. But if you do, let's say you have a $500,000 calculation for your second draw, you don't only need to show that you use the first draw proceeds, you actually need to apply for forgiveness at the same time through the bank that you used. You can go to the next one. I think that one covers what we were already talking about. So some key changes. We talked about the loan amount revenue, the eligibility, the eligibility reduced from 500 to 300 employees is important. I think most on this call probably have less than that anyway, so it may not impact you. The biggest thing here is for the second draw is showing that you have to have at least a 25% reduction in any one quarter over quarter from 19 to 20. So Q1 19 versus Q1 2020. Q2 versus Q2. Now you can use a full 2020 versus 2019, but if you do that, according to the guidance, you'll need to actually have both tax returns to show the year-over-year change. If you do the quarter versus quarter, you can show them unaudited financial statements as the proof of your decrease in gross revenue. And you also, as Kelsey mentioned earlier, you also still have to show that you need it. So for example, if your business is doing great and you're out of the woods, but you had a bad Q2 2020, you can't technically get the loan unless you can say you actually do have an ongoing need it. Next slide, Kelsey. So we just talked about the thing I'll clear up on the gross receipts test. Don't overthink it. What your revenue is what you need to compare. The things I'll point out that make a difference is if it's intercompany transactions. So if you have a company that owns other companies, or you have sister companies that are paying one another, you would exclude those. So it doesn't count positively or negatively against you. And of course, you don't include, if you did have your first draw forgiven, you would exclude that from your 2020 revenue. Okay, next one, Kelsey. You can exclude this one as well, Kelsey, or move to the next one. So on the certification, so the certification is something that is going to receive a lot more attention than it probably did this past time, because as you know, there were a lot of companies in the news that probably shouldn't have gotten a loan, but they did. And so you have to certify that you did not receive a second draw. You're going to have to show and prove that year-over-year gross receipts in excess of 25% decline to get that second draw. You have to use or show you will use the first draw on the eligible expenses. But if you have over $150,000, you will need to show that you will need to apply for forgiveness at that same time. I think you can go to the next one. So this is important if it doesn't fly. So I'll be quickly. So if you can reapply if you did not receive forgiveness, so it's a quick turnaround on that. But if you were impacted by having to return all or part of the original loan, you can't reapply based on the new guidance. And similar, you can. So something that happened to a couple of my clients, they applied probably in that first month of the original PPP. And so as things were changing, there were things they probably could have benefited from if they would have waited. And so you can go back and modify that to apply to whatever that final guidance was. And next, on the simplified loan forgiveness. So if you already had a loan that was under $150,000, previously the application for forgiveness was, it wasn't overly complex, but it was enough to cause just a little bit more paperwork, maybe even have it reviewed by your accountant. But for 150 or less now, it's essentially a one-page form that you attest that you complied with it and that you can get forgiven that way, which is, I think, one of the best news of here, because now that forgiveness can be processed very, very quickly. So I'm going to answer a couple before we go on. I'm going to answer a couple questions that are stacking up. Chase just answered the one on revenue. There is no revenue hurdle, so you don't have to be a certain size to get a loan, because the loan's calculated on your payroll cost. So you don't have to worry about it being at a particular revenue or income. One I see, I'll let Kelsey address the legal part of this, but one thing I get a lot of questions about, and I've seen it on here, is do 1099 employees count as employees for this? First thing I would tell you, and any of my attorneys would tell you, is that don't refer to them as employees, because they're not. They're contractors, and you certainly don't want to run into a situation where they are considered employees, because that has its own legal ramifications. But from a contractor perspective, if you have mostly all contractors, and some of my clients do, so I get that. I know that you can have most of your de facto payroll in contractors. They can actually get their own PPP loan. I know that doesn't help you if you still need to pay them, but the reason and the rationale for them not being part of PPP is they technically can get their own PPP. And so that's why they're not part of the one you can get. And so the question that usually results from that is, well, if I can't get PPP to pay all my 1099 salespeople and contractors, what can I do? Well, from a PPP perspective, you're going to be limited. However, one thing that we didn't talk about that's still available is the EIDL loan. That's separate than the PPP, and that's only through the SBA. So you can actually go to the SBA's website and look at the EIDL loan and apply directly with them. That's kind of outside the scope of what we're talking about. That has its own ramifications, own qualifications, but that is still available for businesses that are out there.
Yeah, and Keith, I'll jump in on that. Yeah, as a small business attorney, I hear that all the time. What do I do with my 1099 employees? And those don't exist. If you have an employee, they should be getting paid a W-2, and you should be withholding and paying employee and employer payroll taxes. If you have legitimate independent contractors and and you are paying them directly and then issuing them 1099s and they are filing their own taxes, then you as the business are not paying any employer taxes and therefore are not eligible for any of the credits, like an employee retention credit. That's technically a credit to your employer taxes. So that's something that, again, outside the scope of this presentation, I'm more than happy to email me. Our emails are going to pop up on the next slide if you have questions about this. But it's really important to know if you are legitimately categorizing someone as an independent contractor versus an employee, not just for PPP and ERC, but in general. And this is just a very real life example of, beyond the Department of Labor filing an investigation against you, that you're not for some of these payroll tax credits. And we know that payroll tax credits are a popular way that the government kind of props up the economy in downturns. So it's something to keep in mind for the future. And then also, as Keith mentioned, EIDL loans are something that's been around for a long time that are for economic disasters. They go back through Hurricane Katrina, the different in specific areas, but under the original CARES Act and CAA, the entire United States is considered a disaster area due to the coronavirus. And because of that, EIDL loans are available to certain companies that have been impacted by that disaster. So that's a separate thing that you can reach out to one of us, or if you have your own CPA about, to help explain the parameters. But as Keith mentioned, it's a really good option for those companies that do operate mainly. The
last thing I'll say on the contractor, not to beat the dead horse, but I'll give you a real life example. So one of my clients, they run an independent sales contractor model. However, they have a company email address, company laptop. They're not allowed to do any other work for any other company. Well, that's an employee. And so when all those people did not receive payments anymore, half of them filed for unemployment. And so now the company has a real mess on its hands, because the government is saying they should have been employees, and of course there's no payroll taxes and whatnot withheld and all that stuff. So Kelsey can address that, but I just want to point out a real example that's kind of separate from this. One question, and then I know Chase had a couple that he could answer better as well. So the pre-revenue question. So I work with a lot of pre-revenue startups, and unfortunately, if you weren't at a point where you were actually paying full-time employees yet, you're still going to be limited on PPP. But even if you had one employee, it's better than nothing. But there isn't a solution on PPP with contractors, as we said. However, looking into EIDL, I'm not aware of what their actual funding status is. Some people can get in and apply, and others they can't. My advice on that, when in doubt, reapply with EIDL, because there is a little bit of a slow process. And it's happened to some of my clients. They apply and they don't hear anything, and then the next day they get an email saying your promissory note's ready to sign. So I would go that route if you don't have contractors.
And Keith, correct me if I'm wrong on this, but there is an amount of PPP that you can take for the owner's
if you were paying yourself as an owner or part of a partner, yes, there is way you can do that as well on Schedule C.
And I see. I'll just touch on that briefly. I saw some questions specifically asking about, I have a Schedule C, I have a sole proprietorship, or which might be. That doesn't mean that you W-2ing yourself. Just the net earnings from that activity would be considered as eligible PPP. I heard some background there for a second, but you could include that self-employment earnings up to the $100,000 annual compensation. So you could take 2.5 times a monthly compensation up to $100,000 of earnings on your Schedule C. I saw another question asking about, well, if I have multiple Schedule Cs, can I just kind of apply for each one of them? The way that the guidance is presented, you should only be eligible for the first one. Effectively, they intend for that $100,000 compensation to apply for it.
Okay, I think your microphone is cutting out a little bit. I'm seeing people can't really hear.
Well, I'll certainly bear with me. I guess it's the foils of a virtual environment. So unfortunately, we'll do the best we can on that one. But point would be that your Schedule C earnings would certainly be includable as part of a PPP application process, but it would be limited to one individual. So if you have multiple LLCs, in theory, your earnings from each one of those wouldn't be duplicative for additional PPP applications. So.
What thing I'll add to Chase's point, which if you're a sole proprietor, it's definitely a good one. The question on the multiple ones, for the actual second draw revenue decline, the guidance is if you have multiples, you actually need to combine the revenue on all of them to meet that test for the decline.
And this is just a quick reminder if this clears up any confusion for people, but your LLC is something that you've elected at the state level with the state of Texas or another state if you so choose. But then all of the PPP and EIDL and ERC is coming through the IRS at the federal level. So if you're a single member LLC, most likely you're being taxed as a sole proprietor. And if you're in a multi-member LLC, you might be taxed as a general partnership. And so that's where some of these issues arise when we're talking about Schedule Cs. That would be for single member LLCs that have not elected S Corp status at the IRS level.
Question, and this, I think we'll address a couple of people's questions. So first of all, I think Kelsey may have mentioned it earlier, but the guidance on this, unfortunately, like the last time, is changing daily. So that's one problem. That's not our fault. It's the government, but they're qualifying things as it goes by. What I would always tell people the first time, at the end of the day, since you have to go through your bank is really the final arbiter of what they want to submit to the SBA. And so if you're working with a bank and you don't think they're interpreting it correctly, or you think they're wrong, well, try a different bank. Because ultimately they're not going to let you apply for something that if they disagree with a particular interpretation. One question on the revenue side is, do you have to use your tax returns, the yearly tax returns? You only have to use that if you're trying to make the case that your overall revenue decreased from 20 to 19. If your overall revenue decreased 20 to 19, then there had to be at least one quarter that was beyond 25%. So in that case, I would actually just do the quarter over quarter comparison and show them financial statements from that. So a financial statement that you could generate from your QuickBooks or your Xero, as long as you attest to that and have that to the bank, then you can use that. If you don't have that, then you can use the quarter over quarter comparison and show them financial statements from that. So a financial statement that you could generate from your QuickBooks or your Xero, as long as you attest to that and have that to the bank, then you can use that. If you don't have that, then you can use the quarter over quarter comparison and show them financial statements from that. So then that's fine. But again, maybe your bank is fine with you signing it. Maybe your bank wants something else. You're going to get into some areas where your bank may just have a particular preference to protect them more so than another one.
And Keith, that brings up a question. I think it was the first one we got. What if I'm not a member or I'm not currently using a community bank or credit union? It's always worth reaching out. Different banks have different rules about if they will process applications for non-customers, or if you need to open an account, what kind of account. The other thing is, again, when we send these slides out, I did include those links to the various fintech options. It's a fancy way of saying financial technology companies, but online based companies that act maybe not necessarily as a bank holding deposits, but doing loans. A number of them have been approved by the SBA to process PPP. So if you really are running into issues with your bank or credit union and can't find a bank or credit union who you can or want to work with, that's another good option. We're not going to bring up the names of any of them because we're not endorsing any of them, but I think some of them, we're joking, they're kind of surprising. Some of these companies don't sound real legitimate. So again, check them out on the SBA's website. But a lot of our various clients and friends and family have had success using some of those online processors.
What question on the LLC, just to clarify, so Chase's point on the combining the earnings and the cap, 1,000% true. The question related to that about combining, my point was separate from Chase's on what is actually going to be the loan amount. Mine is on to do the 25% loss of revenue or the revenue decline test. You have to combine your business's revenue. So for example, if let's say you have one business that's 100,000 in revenue, you have two businesses and they're $100,000 each. One increased and one decreased. If that total wasn't a 25% decrease, you technically wouldn't be eligible for the second round based on the 25% reduction in revenue. The extending your existing so with that, so our advice, I'm not mentioning a specific bank, it will be easier to do a second draw with your existing, the bank that did your first one. They have all your documentation. It's going to be a much easier process. Some banks are allowing non-customers, some aren't. It just depends. So, but if you do ready to apply to a bank, you're going to need all those documents you do to set up an account. They may even require you to have a checking account, which, if you're like any of the clients we all work with, you don't care, you're desperate, you'll take it for a new checking account. So just keep that in mind. And I don't know if I'd give you this is official advice, but whatever bank wins when it comes to the ones you talk to and apply with.
Yeah, and as a reminder, you're allowed to have accounts at different banks. I have a number of clients who do that. Hedging your bets with a large bank and a smaller bank, just in general, is not a bad idea. Again, not technically advice or legal advice, but it's allowed. And if you happen to find a credit union or a community bank that can help you, this is a good time to kind of shop around a little bit and maybe try them out. And again, going back to that slide, in addition to fintech, an organization that partners with the DEC occasionally is People Fund. And one of their missions is to connect underserved populations with bankers, and traditionally underbanked populations with bankers. Excuse me.
Armando, the question on the confusion and contradictions between the PPP loan and the actual bank application. So right as of now, the EIDL is no longer included in that, or it doesn't get taken out. So that's probably why you're seeing it on the bank portal that way. And so, but again, that's where things are changing by the hour, by the day. Whatever your bank application was what I would consider the gospel in terms of what you apply. So even if you read something last week, or we say something today, and you go to apply Tuesday, and the application's different, you have to assume it's right, because the bank is the one that's actually going to transmit that and get you the funding through the SBA. should you apply with multiple banks? I would leave that one up to you. I can't say that some of my clients did not, broadcast a lot of applications and see who got it first. Some of these banks, it's all hands on deck. You have mortgage people helping do the loans, and so it's a busy time. I wouldn't say it's the wrong thing to do. The only thing is, I would, for me, I would let them know you're applying and let them know that there's certainly a time premium on who can do it first. And you'd be surprised, a lot of these banks are getting new business and new relationships this way. So I don't think it would hurt.
Yeah, and I don't know if you can hear me at all this time. Sorry for the mic, but I would say I wouldn't send multiple applications to the SBA.
Yeah, exactly.
Once you get to the final stage.
No, exactly. It's whoever gets it to the SBA first. Usually they would make you sign something before you do that. But yes, thanks for clarifying, Chase. This is only for what banks get back to you and say, we're ready to go. I'm ready to transmit this. The pre-revenue. So if you're pre-revenue, then no, the second draw would not apply because you don't have any revenue to show that you declined. However, you could potentially, there is some ambiguity on the first draw, looking at the first draw and still basing a paycheck protection loan on your employees. So I had a client that was in the middle of clinical trials during COVID, huge disruption, no revenue, but it significantly impacted their operations, and they were able to get one from that first round. If anyone asked an earlier question and we haven't gotten to it, feel free to repost it. I'm looking through them now, and I'm sure Chase and Kelsey are as well.
Looks like we have a new one in. Is there any relief for a new nonprofit that cannot operate?
That might be one where you could reach out to a bank or to one of us, your trusted advisor, about if you fall under the round one, although again, you would need to have been open in 2019 or prior to February 15th. The other option would be EIDL. Like I said, we're not getting into this here, and you have to meet certain criteria for that. But when you do reach out to, especially to a bank about applying for first round or to EIDL, banks have loans available as well. Of course, this is government. We're talking about government forgivable loans, definitely preferable to a bank loan, but you're not completely out of money options. You're just potentially out of federally funded loan forgiveness options.
I can read Richard's question because it looks like it's two parts. It says, I received a PPP loan for company employees for a company last year, but I did not file for a company. So he has two LLCs, right? I have two single member LLCs, and I filed my taxes on my Schedule C as a sole proprietor with no W-2 employees. I received a PPP loan for company A last year, but I did not file for company B. Can I file for two PPP loans? Meaning, can I file for PPP Draw 2 with company A and then apply with a new and separate application with company B?
I put notes in the chat.
Chase, did you answer that already? Maybe.
Yeah, I think what Chase mentioned, you can include earnings from both LLCs, but it's capped at the 100% annual comp. So my interpretation of that is that whether you do one or two, it's still capped at the same amount. Is that right, Chase?
Yeah. Okay.
Yes.
So a question on tax component of PPP, is it loan or revenue? So I'll let the tax expert address that one. What I'll address on that I get a lot on the financial statement side, whether it's for an investor or a pitch deck on your revenue. The forgiveness is not, and similar with the EIDL grant, the forgiveness is not revenue. It's considered a component of other income, and so it won't help you on the financial statement side for revenue. And it should not be a part of operating income that you would show to a potential investor. I'll let Chase talk about the actual tax part of that, though, how it impacts taxes on a loan or revenue side.
Yeah, I mean, the short answer is it's not taxable on either side. It's not taxable earnings to you when it's forgiven, and the expenses are still deductible. So it's purely tax free. I can circulate some thoughts in our follow-up recap.
I wouldn't speculate about EIDL loans being forgiven or becoming grants. That I would say anything's possible at this point with what Congress and the new administration are going to develop. And so I couldn't say whether or not it will be, but that's where I would stay glued to the SBA site, as well as talking to your bankers as well. One thing.
And the purpose of EIDL loans, like I said, they've existed for a long time pre-COVID. Is they're very low interest with very long terms. So it's a way to finance something with very minimal monthly payments, not necessarily to have a forgiven loan like PPP.
One thing I want to clarify on the PPP side, and I get the sense that there might be some pre-revenue or venture startups. Be careful with the PPP because there are rules around changes in ownership. I mean, this is for any business, but I know for startups. So if you're a founder, you have 100%, you raise 5 million, and now you have 45%. That's a change in ownership, and that can actually put the PPP automatically in default. And so you technically need the SBA's permission to have a change in ownership like that. So if you're a pre-revenue startup and you're doing PPP, or even if you're a post-revenue startup doing PPP, and you're going to get acquired, or you're going to have new investment that becomes the majority owner, you need to stop before you close and get the SBA's guidance on that directly, and your banker will know how to do that.
And I'll jump in. That's actually the case as well for EIDL.
Yeah.
There are ways to get the permissions, and there's ways to structure around it. But if you're going through funding right now, you should probably have advisors, bankers, CPAs, lawyers working with you. And if you don't, please get them on board immediately, because that is a little bit of a tricky workaround. I'll leave it at that.
The question on forgiveness, I saw this earlier. So one thing that drove me crazy at the end of the year were banks kind of intimidating my clients that they had to apply for forgiveness. The answer is no, they didn't. So banks wanted to get all these loans off their books as of 12/31. They didn't want them on their balance sheet as being unforgiven, so they wanted them forgiven. They were also trying to manage their own resources and processing also. You have, for the most part, unless it changes, up until 10 months after your covered period to apply for forgiveness. So that means if you had your covered period until October, I mean, you're looking at into the summer before you would need to apply for forgiveness. So just keep that in mind. If your bank tells you you have to apply, get them to clarify the rules, and they'll know that you don't have to do it right this second.
This is great, guys. I know we're out of time, and of course, I want to be respectful of everyone's time. Your questions have been absolutely amazing. I definitely want to thank our panel for just all of the amazing, knowledge and advice that you all have been able to share in this short time frame. Again, we are definitely going to send out the video as well as the slides, and you will have each panelist information on there. And so feel free to send questions my way. Like if you want to still put your questions in the chat, we can still pull those and then send those out to everyone. But it seems like we've done so far, you all have done a great job of just jumping in the chat and getting a lot of those questions answered. But if there's just some lingering questions, again, you'll have the contact information. You can also send that my way, and we're happy to get all of these things out to you. So we will put together a resource toolkit for you all that addresses a lot of your concerns or a lot of your questions, and hopefully it'll be helpful to you all. And again, you have everyone here that spoke with you today that's happy to provide that extra support. I definitely want to thank you all for coming out today. I know that it was a quick turnaround, but you all have been just very in tune and just engaged. And so want to thank you all. Want to thank all of our partners. Want to thank Doug, who helped put this together as well, who's my colleague here. So again, continue to put your questions in the chat. Thank you for coming out today. Thank you to our panelists. If there's anything that you all want to say, feel free to. Otherwise, we can definitely wrap everything up. We're good to go? Awesome. Well, thank you, everyone. And we'll talk to you all soon. And I'll be sending this information out to you within the next few days. So just be on the lookout for that and reach out if you need anything. Thank you.